You're now listening to the TaxSmart REI podcast, the number one tax podcast for real estate investors. Hey, thanks for tuning into this week's episode of the TaxSmart REI podcast. Today, we're going to be answering questions from our TaxSmart investors public community as well as the Facebook group. We'll be diving into all of that in just 1 minute. Are you ready to prepare for 2025 with strategies that will save you money and optimize your real estate portfolio? Hall CPA and TaxSmart Investors is bringing you the Year-End Tax Impact, a one-day virtual event where it will be equipping you with the tools you need to finish the year strong and dominate the year ahead. At this event, you'll hear from top industry experts on essential topics like how the post-election results will shape your investments and your taxes. You'll also discover wealth-building strategies designed for 2025 and beyond. Plus, you'll learn year-end power moves so you can optimize your taxes before the clock runs out. And for our VIP investors, you'll get exclusive access to a tax strategy panel and even a live Q&A where you get answers to your most pressing questions. If you're an individual investor or small partnership, this event is specifically tailored for you. And the best part, no travel required. You can join us from the comfort of your own home via Zoom. Don't miss out. Reserve your free ticket now by visiting www.taxsmartinvestors.com/year-end-tax-impact and arm yourself with the strategies and insights that could save you money, time, and a whole lot of headaches. With over 500 investors expected to attend, this is your chance to connect, learn, and prepare for a prosperous 2025. Again, just head over to www.taxsmartinvestors.com/year-end-tax-impact to grab your free tickets today. We'll see you there, but for now, we'll dive right into today's episode. All right, and we're back. So again, we're going to be taking questions today from our Facebook community as well as the public community. If you're not already in the public community, you can join by going to www.taxsmartinvestors.com/public to join today. It's free, so we'd love to see you in there. But we're going to go ahead and just get started with some questions. And the first question is going to be from somebody who's a first-time Airbnb host, and they are filing their tax returns. They're wondering whether, believe it or not, this is actually taking place after the filing deadline. But do we file Schedule C or Schedule E? For context, the house is also our primary home, and we're renting 3 rooms and staying in 1 room. They appreciate any guidance. All right, so for anybody who's renting a property, whether it's on Airbnb or elsewhere, and you are not providing substantial services, all right, this is the key delineation here. You are not providing substantial services. Substantial services are hotel-like services you'll find in a hotel, like daily cleaning, daily meals, concierge, vouchers, so on and so forth. If you're not providing substantial services, it goes on Schedule E, period, end of story. We have all the citations we discussed here on the show. If you do want a complete download of the citations, you can go purchase the STR Tax Secrets book. Believe it or not, it is still on sale for $1 right now. We decided to extend that to allow some more people to buy it who've been waiting on it. And in that book, we not only have the citations in the book, we also have a citation guide in the resources section of the book where this is all detailed out. So if you're CPA, EA, or if your CPA or EA is asking for these details, you can find that within that book.
Yeah. Yep. Schedule E. That's a super common question that we get. And just to add one little thing and then we can move on. I have so commonly seen, whether it's people self-preparing their own tax return in TurboTax, H&R Block, whatever it is, it's so common to see it on Schedule C because oftentimes within the software, it is hard to get something to be on a Schedule E as a rental without claiming real estate professional status. It's super confusing. The tax softwares, most places haven't made this very intuitive. I've even had a prospect that we were talking with, someone who's interested in working with us, basically say, I just can't figure this out. Can you help me? And yes, we know how to do this. We even in our own tax software as a firm, we know how to do that very easy. Once we've done it, thousands of times, probably at this point. But also just even within TurboTax, it can be confusing. So please do put it on the right form. I know it can be tempting to just put it on Schedule C. It almost by default become non-passive, which is really what you're trying to do is get that loss theoretically to show as non-passive. But it's just not technically correct. And depending on your profitability that year, it could actually mess with your self-employment income tax calculation. So you just have to be very careful there. But yes, short answer, Schedule E, not Schedule C.
Absolutely. All right, so moving along to the next question, Ryan, if you want to take this one. Does anyone know if I can use the short-term rental loophole or real estate professional status to write off taxes from a traditional 401k to Roth conversion?
So essentially what's going on there is we're trying to match non-passive to non-passive, I think is really the question there. And at the end of the day, yes. So if you've got a, conversion there. You've got actual federal income tax being shown, federal income, right? You've got this triggering event. Yes. You've got income that comes through as a non-passive income. If we're then using something like real estate professional status, the short-term rental strategy, then you're getting a loss and we meet the requirements. Yes, that can then come in as a non-passive loss to neutralize, depending on the numbers, right? Could neutralize, do even more, maybe not all quite of it. But basically the short answer is yes. But here's a nuance that I've just went through recently this last week, was that if you've got a 10% early withdrawal penalty within there, it cannot offset that penalty. Just want to make sure that's clear to people. So you've got federal income tax liability, right? Maybe you're in the 35% bracket. Then you've got maybe a 10% early withdrawal penalty. You cannot have more losses to offset that 10% penalty. That's a penalty. It's not really tax. It's kind of the separation there. So people just need to be careful. You can, yes, offset the tax, but we're not going to be able to offset any sort of penalty, that early 10% withdrawal penalty. So anything you'd add, Tom?
No, I think you hit the nail on the head. At the end of the day, when you do a conversion, you're going to have basically, you're going to recognize income. It's typically going to be, it's almost always, actually, it's always going to be non-passive, right? And at that point, if you want to use losses to offset that income, you're going to have non-passive losses, which can come through the STR loophole or real estate professional status. All right, so moving on right along to the next question. We have two short-term rentals. Are the meals during supply shopping 100% deductible? We have to drive 1 to 2 hours to get supplies. Also, meals with cleaners, is that 50% or 100% deductible? How about travel expenses, meals and lodging for market research? All right, let's just start breaking this down bit by bit here. So when you're traveling outside of your tax home, which is generally going to be considered 40 miles within the radius of your business, then business meals will be tax deductible when you're not with other business associates, right? So if you're eating at McDonald's yourself after traveling 45 miles outside of your tax home, for example, those business meals will generally be tax deductible, okay? Now, they're going to be 50% tax deductible, all right? Right now, meals are not 100% tax deductible. It was like that for a period of time to help restaurants after COVID, but it's over. So it would be 50% tax deductible. Now, if you're taking your cleaners out for meals for whatever reason, because you're with a business associate, right, or business contact at that point, that will also be 50% tax deductible. All right. Now, travel expenses, meals, and lodging for market research for looking at a prospective property. We've covered this here before on the show and in other places. Generally, if you do not have a property in the market in which you're traveling to, those expenses will not be immediately tax deductible, but they will be capitalized to the purchase of your first property in that market, should that ever occur. And then after that, after you have a property in that market, travel to that market for business reasons later on after the property is acquired does become tax deductible as an expense in that current year.
Yeah. And maybe to double down on that, like at best, your meals are going to be 50% deductible. I don't know. At least if it's me, I'm not going crazy about trying to capture every single receipt. To me, if I'm the IRS and I see a huge number in there in meals these days, I'm flagging that. And I don't know what their system flags and how that works. But if I'm seeing a big thing in meals, I'm like, oh, probably not, right? It's probably not true because there's just so many little nuances. And keep in mind, you're only getting a 50% deduction, okay? And as you think about food, we all have to eat. So there's a very high percentage chance that actually what you're trying to deduct is just personal, okay? So you just have to be very careful and just understand too, like, is this worth my time to try to keep track of this $20 meal, right? Maybe you're at, I don't know, Chipotle, Qdoba, something, you're getting a burrito, whatever. You're only going to get $10. Okay, times your tax rate, whatever that is. Okay, fantastic. Was that worth it? So all that to say, then we've got the travel aspect. And the travel, we're talking a mile or two, or sorry, an hour or two of travel. So we're not talking about like plane tickets or anything like that. But the other thing to keep in mind when it comes to travel from like your home to another destination, like we said, place to get supplies, or even to probably then, right, the short-term rental or short-term rentals, we've got to be considering which of those miles are even deductible. Okay. And the key aspect that I want our listeners to keep in mind is the home office. Okay. If you simply go from your home and it is just your primary, it is not a home office for that business, and then you travel to, say, your rental property, that is possibly just personal and it's not business miles. Okay. But if we're going from a home office for this business and now I'm going to the rental, okay, now we've got business mileage, right? Whereas the first example I said would just be commuting miles, is usually what the IRS will call that. So just be careful, even on those little nuances, that having a home office generally, especially if you're doing this a lot, is beneficial for you, not only to get those more miles as a deduction, but number two, also to potentially get some of that home office deduction. Depending on your losses and whatnot, it could be an extra amount of tax savings for you.
Absolutely. Moving along to the next question. I bought a car in late 2023, but except for the down payment, the payments did not start until 2024. Does this vehicle go on my 2023 or 2024 tax return?
Yeah. At the end of the day, at least to me, it's about when was the vehicle actually used for business? Because theoretically, okay, cool, I put down the down payment. Okay, did you actually drive any miles on that vehicle? Right. So for example, I think it was my sister put down a down payment for a Tesla, and then it was like, hey, cool, yep, come back in 30 days and you can get your car. So it really depends on, like, do you even have the car? Have you actually driven it for business to even determine, do I have something to deduct for miles? Do I have depreciation to deduct, bonus depreciation, all that kind of stuff? So at least to me, if we've got 0 miles, 0 personal, 0 business, I mean, to me, it's at best, like, sure, placed in service, but it's 0%. Like we can't even have any evidence to say it's business or personal. But on top of that, if we're actually getting miles, let's just assume that in a different situation. If we're actually getting that, then we just need to determine, okay, what percentage are business versus personal? And then it sounds like if we're doing a down payment, it's not a lease. And so then, like, it doesn't really matter how much we've put down. You could put down $1 and the same amount of bonus depreciation is going to apply whether you 100% finance it or 0% finance it. That's one of the cool things about using leverage, right? Just like a property, okay, rental property, using that as an example, you could go 100% leverage a real estate property, do a cost seg, you got it placed in service, do a cost seg, get all these losses for depreciation, but again, have 100% financed. It's the same amount of deductions whether you put in 100% cash or 100% finance from the bank. So the financing of it doesn't usually impact at all deductibility of depreciation.
Right. So it sounds like the bottom line is, if in 2023 they did not use the car at all for business, then it would not go in the 2023 tax return. But if they did use it for business in 2023, then it could potentially be going on the 2023 tax return.
Yeah, for sure.
Moving along, we do have one about QBO. It's very good to get a QBO question. How do you classify an expense for taking photos for your short-term rental listing? So I guess if you had like a photographer come in and do a photo shoot or like take pictures of your property, that would probably be an advertising expense, unless I'm completely off base there. But I'm pretty sure that'd be an advertising expense, very plain and simple.
Yep. And just for people listening, if you're like, what the heck is QBO? We're using acronyms here. So just QuickBooks Online is QBO. Obviously super popular for our clients to be using and listeners to be using. Really good. We highly recommend that for those of you looking for an accounting system.
100%. So we have one here. Can I write off a home warranty? So if it's for a personal property, I don't believe you would write it off. You'd probably capitalize that to the purchase of the property. And if it was for a rental property, you did have a home build, like they guaranteed the build for a certain period of time, that would most likely be capitalized and amortized or depreciated over the useful life of the property, because it is something that extends beyond, I assume, 1 year.
Yeah, there's probably some nuances there. I agree with everything you've said. If it's something that, I don't know, you got your property placed in service, maybe you're buying a warranty on, I don't know, a refrigerator or something like that, it could just be seen as a part of the cost of the refrigerator potentially. And so then kind of depending on where things land, you might just, 5-year bonus depreciate that, or depending on price, you might just say, hey, yep, under the de minimis safe harbor, just fully expense that. Likely, if it's placed in service, yes, it's probably an expense. But then, like you said, depending on when this is kind of going into service, is it a new build, or is this like I got the warranty as part of my acquisition for this home or something like that, then it could be capitalized, right?
With the end of 2024 right around the corner, now's the perfect time to start planning what moves you're going to make to optimize your tax situation before the year ends and get a head start on 2025. Whether you're looking to use the real estate professional status, the short-term rental loophole, cost segregation studies, 1031 exchanges, or anything in between, our team is here to help you through proactive tax strategy and planning, painless tax filing, and streamlined bookkeeping services. After helping thousands of investors save millions of dollars in taxes, we want to help you. So whether you're looking to finish the year strong or get a head start on 2025, what are you waiting for? Head on over to www.therealestatecpa.com/podcast to request a free 30-minute discovery call today. We're looking forward to learning more about your situation and how we can help. Again, that's www.therealestatecpa.com/podcast to request a free 30-minute discovery call. We look forward to hearing from you, but for now, right back into today's episode.
All right, we got another one here. Is there a creative way to use capital gains proceeds from the sale of stock to purchase investment real estate? Trying to figure out how to minimize my short-term capital gains tax on the sale of the stock. So look at your take on this, Ryan, but I'm going to go with probably an opportunity zone fund.
That's where I was going.
So that's, I think I said briefly, what opportunity zone fund allows you to do is allows you to defer your capital gains tax on the sale of any capital asset virtually that produces capital gains tax by investing your capital gains, it has to be the capital gains, into a qualified opportunity zone fund, generally within 180 days of the sale of that capital asset. And there's some stipulations around that with timing, depending on if it's from a partnership, but we're not going to go into all those details. Generally, it's from 180 days of sale. When it's in the qualified opportunity zone fund, you will defer it until the end of 2026, or until you sell your interest in the opportunity zone fund, whichever comes first. In 2026, those taxes will come due on the capital gain. The benefit of doing this, though, is if you hold your interest in the qualified opportunity zone fund for 10 years or more, then the gain on the sale of the actual opportunity zone fund or its assets after 10 years, the actual gain on that is going to be tax exempt, which is the real power of the qualified opportunity zone fund.
Yep. That's where I was going to go, because we're not talking real estate, which you would have some options like 1031 exchanges and things like that. Really, if we're talking stock sale capital gain, we're probably going to talk first and foremost about qualified opportunity zone, like you said. And just if people are listening to this, like, hey, I want to learn more about qualified opportunity zone funds, things like that. We've had a couple podcasts in our arsenal here kind of just talking about that. Barrett Lindbergh, forget his last name exactly, but he's been on once or twice on our podcast to talk about qualified opportunity zones. We've had a couple other ones, even our major real estate podcast, kind of additional podcasts like this. We've talked about that. So there's tons of information out there. But like Tom said, the tax is going to come due 2026. That's effective when it comes in. But the gain on top of that investment could be basically gone, not pay tax on that if you hold it for 10 years, like you said. So yep, I'd be going with QOZ as well.
Right. That's probably the best way. Otherwise, you'd have to be looking at using like the real estate professional status or short-term rental loophole, getting into the property quickly, and then using the non-passive losses to offset the loss. The gain on the sale of stocks. But that at this point of the year, probably a little bit challenging to pull off. Not saying you can't pull off, probably challenging.
Or like a tax loss harvesting type thing. You could look at if you have any other capital losses or something carrying forward, or anything else in like a brokerage account that you'd want to sell to capture a loss. But yeah, depends on your situation there.
Yeah, I mean, other than that, that's probably the main things that come to mind. Do have a few more interesting questions that are coming in through TaxSmart Investors. Always a good time here. So did a cost seg with bonus depreciation on our short-term rental 2 years ago. Now I want to add a deck attached to the base of the house. Does this help anyway tax-wise? Our tax person said this is not beneficial. Usually decks are 15-year property, if I'm not mistaken.
Yeah, I'd be curious what they mean by not beneficial. Maybe they just meant, hey, yeah, you got to capitalize it, and then maybe just thought that it was a 39-year property or something like that. But if it's 15-year property, which most decks are going to be, right? It's on the land. So a land improvement, 15 years, we're still today, right? 2024, 60%. Bonus depreciation, I mean, you could still, if it's a $10,000 deck, for example, cool, we can accelerate 6,000 of that in 2024. To me, that's not terrible. Sure, you might not be able to expense all of it, but you can at least get that. But maybe the nuance actually, Tom, is the tax preparer saying, basically, you're going to be passive, maybe. I can't remember the full context in the question, but maybe they're thinking you're going to be passive, and therefore I can't like offset any of your W-2 or something like that. maybe that was what the intention was.
Yeah, perhaps that's what they mean. Because just for some context for everybody who's listening here, if you've been a long time listener, you already know this. But if you're new or maybe you just need a refresher, usually what ends up happening is the short-term rental, and with the short-term rental loophole strategy, is you're going to run the cost segregation study in the first year. You're going to capture the tax benefits while the property is non-passive, so you'll materially participate, all of that good stuff. Now, usually in subsequent years, not always, in subsequent years, many taxpayers look to make that property passive by no longer materially participating. So perhaps in year 2 or year 3, it sounds like maybe in this case, you are no longer, to Ryan's point, you are no longer non-passive, and in this case, it's passive, in which case the losses from that generated by the installation of that deck could be passive for you, and there may not be an immediate tax benefit.
Yeah, I was just going to say one thing, Tom, and then we move on. I have had a couple clients where the first year we kind of follow the short-term rental strategy requirements, and they're very excited about the tax savings they get. Awesome. I have had a couple people recently who I've said, "Hey, what about the second year?" And they're kind of like, "What do you mean the second year? Like, I'm done, right?" And it's like, no. Like, are you going to materially participate in year 2 of whatever your ownership is? And they're like, well, yeah, it's still like we're doing certain things, we're still self-managing and whatever. And then I ask about like, okay, what are you kind of expecting, net loss to be, or net profit, whatever it is? And they're like, oh, after depreciation, it's probably still going to be like a negative $20,000 loss. And some people just automatically think they maybe don't need to claim the short-term rental strategy, but that's a $20,000 loss that they could then use to offset their business profits, W-2, whatever it is. And I think some people just kind of forget about the second year. We harp on year 1. Hey, cost seg, short-term rental strategy, go buy this 7-day average, materially participate. The only difference in year 2 that's really going to benefit you with the short-term rental strategy is, assuming we meet the requirements, is are you going to continue to be at a loss? If you are, depending on how big that is, then hey, it's still beneficial for you to materially participate. Okay. Not only that, but basically like it could be an effect for year 3, year 4, kind of depending on how things go. So just keep in mind, we harp on year 1. This could still be a benefit in year 2 or 3 or 4, depending on profitability and depreciation you continue to take. So for those listening who've been listening for a long time, please keep in mind the second year and onward could have an impact to continue to meet that. You just need to know how you're doing for losses.
Hey TaxSmart investors, Thomas Castelli here, and I want to let you know that I recently started my own YouTube channel where I'll be releasing weekly videos on tax and wealth tips for real estate investors and business owners, and of course I'll be covering many personal tax strategies as well. But that's not all. I'm also going to be sharing the tips and lessons I learned by investing as a limited partner in real estate syndicates and funds, which you'll only find available on YouTube, and I'll be diving even deeper in TaxSmart insiders. And lastly, in the not so distant future, I plan to cover estate planning strategies for real estate investors, and you'll only find that on YouTube. Subscribe today so you don't miss a beat by visiting youtube.com/@ThomasCastelli or by searching @ThomasCastelli on YouTube. Again, subscribe today at youtube.com/@ThomasCastelli. I'll see you over there, but for now, right back to today's episode.
So I think we're going to take maybe 2 or 3 more questions and we'll wrap this episode up. But there are a lot of interesting questions that come up here. We got one about how to calculate personal use days versus business days when visiting a short-term rental property. This person says, I've heard something about a 4-hour threshold. Is there a per calendar day or is it an average per day basis? So for example, if I work 16 hours in 2 days for deep exterior cleaning, does it count as 4 days or only 2? What is Okay. So I see what's going on here. Okay. So under section 280A, right, it says that if you work on a property, if you're traveling to your property, primarily working on repairs and maintenance on a quote unquote substantially full-time basis, then it's not considered a personal use day. They do not define within substantially full-time, because I've been getting a lot of questions about this recently, what substantially full-time means. If you look to other areas of the tax code where they say substantially full-time, it's usually somewhere between 30 to 40 hours per week, which means it's somewhere around 4 to 6 hours per day, right? And that's on a per day basis. So if you work 16 hours over 2 days, sounds like it's roughly 8 hours per day. That would be considered substantially full-time over those 2 days. It's not on an average. So if you went for 4 days, you're not dividing the time you're spending by the amount of days you were there. So if you worked 8 hours on one day, 8 hours on day 2, then you work substantially full-time on those 2 days. But if you're there for a total of 4 days, those other 2 days you were there, assuming you didn't do any work on a substantially full-time basis, those would still be personal use days. It's not averaged out.
Yep. So I think if we're going to be as direct as possible to their question, it's per calendar day. It's not like an average per day. So it's not 16 divided by 4. It's like, okay, well, how many did you do day 1? How many did you do day 2? How many day 3 and 4? Anything that, we've kind of said rule of thumb 4, like more than 4. So
Yeah.
anything more than 4, even if you got 16 hours in one day, that's your only business day. If every other day is 0, they're all personal as far as we're concerned and our understanding of the code and things like that. So yeah, we would say it's really looked at as a per calendar day basis.
Right. Yeah, absolutely. And, I'll say one more thing on this before we move on, because like I said, I have been getting a lot of questions on this. Someone was asking in the insiders group, they were trying to get, I would say, relatively aggressive with this rule. Like, you have to ask yourself, why are you buying this short-term rental property, right? What is the real reason you're buying this? Are you buying a vacation property because you want to use it personally? If you want to use it personally, then use it personally and understand you probably won't be able to use the short-term rental loophole if you're going to be spending more than 14 personal use days, right? Don't try to stretch it and try to make up stuff you're doing at the property, okay? Because the IRS is increasing audits on short-term rental properties and probably across the board, but we're seeing them a lot on short-term rentals because we happen to have a lot of people come to us for help on short-term rental properties. So you don't want to get too cute, right? If you're going to be using it personally and you want to enjoy the property for its personal use, you probably won't be able to use the short-term rental loophole. Or what you can do is you can buy the property for the first year that you're going to use the short-term rental loophole. Just don't use it personally, right? Or use it personally for less than 14 days. Try to keep it as simple as possible, because what ends up happening is if you try to get too cute with the rules, you start to thread a needle, right? And not only can it be hard for you to track this and keep track of everything, but if you do get under audited and this does come under question about your personal use, and you have to try to explain that to an auditor, you're risking them misinterpreting or misunderstanding what you're communicating to them. Or you did get too aggressive and they just disregard, and they say it's basically a residence, right? That's what my concern is, right? So you don't want to let the tax tail wag the dog. If you want to use it personally, then use it personally. If you want to use it for a short-term rental, then stay 14 days or less under personal use, right? You want to keep it as clean as possible when you're trying to use a strategy that has massive tax savings and also could come under scrutiny. So
yeah, yep. And I've always told my wife that if we buy a short-term rental, it's the first year that I care most about not using it personally. Year 2, 3, 4, 5, 6, 7, 8, 9, 10 plus, I don't care as much, because usually that first year you care about getting the cost segregation study, and you don't want to have any personal use to get less depreciation, especially in that first year. Now, you still have to be careful, because I've talked about this with a couple of clients. They're like, oh, I'll make it a short-term rental the first year, and then immediately the second year, I'm going to make it a primary residence. It's like, that is going to be very questionable of, okay, what was your intent here from the beginning? That's usually probably what the IRS is going to come to. Was your intent here to just get the tax savings in the first year, but really you bought this knowing this was going to be kind of a primary or secondary home that you were going to move into personally? Well, okay, well, is this really even valid? Like, yeah, you got some rents, you got, average stay, blah, 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 material participation. There's just a huge amount of risk that could come with them really questioning intentions and then potentially even unwinding the benefits. So please be careful. I was just talking about the second year, of it being a short-term rental, right? The losses in my example. But even when it comes to this, right, we got to be careful of second use, even with personal use, or is it just something that you're going to like all of a sudden make it full-time residence? We do have to be careful there, even though it might not at the outset look like this is going to be a big issue. So please be careful.
All right. So we'll take one more question from the TaxSmart investors groups. And then Ryan, if you do have any frequent questions you've been getting, I want to hear if there's like a number one question you've been getting that you'd want to share, and then I can maybe do one too. All right. So the last one from the Facebook group itself. How long do I need to keep tax records for after filing my tax return? So the IRS says you should be keeping these for at least 3 years from the date you file your tax return or from the date that you paid your tax return, your tax bill, whichever was later, right? So 3 years. What a lot of people are doing these days, though, they are keeping electronic versions of their files, indefinitely, because, when you're talking about a tax return, you're talking about a few megabytes of a PDF file or PDF files in the cloud or on a hard drive. that are relatively small footprint, you could always have those documents for the future. Is there anything you wanted to add there, Ryan?
Yeah, I mean, it's kind of like bare minimum. Sure, 3 years. I think there's a rule about 7 years. If there's like an audit or something, don't quote me on that. I think there's like an extension there, depending on some additional facts or something. But yeah, if it's me, like, I don't know, if it's digital, I'm not deleting anything. I can see people either one, like running out of storage space for some reason and just like, hey, can I purge some of these files? Maybe. Or if it's physical receipts or physical documents, yeah, maybe that's like, hey, I kind of want to purge some of my office space or whatever. But I don't know. Just today, I think most people are using mostly electronic, but some people are still paper filing or printing out things as a copy. That's fine. But yeah, 3 years is, I think, the minimum that you want to do.
Yeah, absolutely. And just for the record here, I did pull up the official IRS language for everybody. Keep records for 3 years from the date you filed your original return or 2 years from the date you paid your tax, whichever is later. Okay. So just keep that in mind. But like we said, you have electronic files, keep them forever, right? Quote unquote, forever. All right. So before we wrap up here, Ryan, is there any frequently asked questions you've been getting from clients or maybe prospective clients that would be worth noting?
One question, yeah, I have been getting from a couple of my clients as we get through closer to the year end. Some people are just looking like, hey, I'm not going to buy another property. It just kind of feels a little bit unrealistic with 2 months or so left in the year. What else can I do from tax savings? They're like, I've done this. I've done my HSA. I've done my retirement contributions. I've done my cost seg. I've paid my kids, right? I've looked at my entity structure. All those things we just did our year-end tax saving strategies a little bit ago. Is there anything else? And sometimes I will bring up oil and gas investing, right? It's a little obscure for some of our listeners or even our clients, but it is tangential to real estate because you're owning land theoretically, and people are looking for tax savings, okay? And because we are kind of the real estate experts, we are very familiar with Section 469 in the tax code. So what I just wanted to highlight for some people, some listeners, is under code section 469C3A, I'm going to start with, is really actually the point I'll just read. Basically, we've got a section in here just related to working interest in oil and gas. Okay. Now, just to read it to you kind of word for word, and then I just want to make one quick comment. This is what it says. The term passive activity is going to be a bunch of legalese, so just forgive me for a second. Okay. It's going to sound confusing to just listening to this. The term passive activity shall not include any working interest in any oil or gas property which the taxpayer holds directly or through an entity which does not limit the liability of the taxpayer with respect to such interest, period. Right? So the interest is in the oil and gas, the working interest. So the point there is one of two things. One, you need to hold it directly, meaning in your own name. So if I'm doing this, it's, hey, Ryan Carrier owns a, interest in this working interest oil and gas, or through an entity which does not limit the liability of the taxpayer. So meaning no LLCs, no single member LLCs, no partnerships, nothing like that to limit my liability. So the thing I just want to point out there is we have to be careful of how we own this. Owning it directly is kind of the default. You could do like, in my understanding would be like a general partnership sort of thing. But at the end of the day, I don't know why you do that off the top of my head. But point is, the question I've been getting is, what can I do? Working interest in oil and gas is something to explore, but just be careful of how you're holding this. Generally, it should be directly in your own name. Yes, there's additional risk. We talked through that in some recent podcast episodes, but point is that you need to own this correctly in order to get the tax savings that you're looking for non-passive losses. So that was mine, Tom. Do you have one that you've been seeing a lot recently?
Yeah, I mean, the one about the personal use on the property has been the one I've been seeing because there's a lot of people wanting to use their properties in ways that are, it's almost like their true intent is to use it as a personal use property and they're just trying to squeak by. And, with the short-term rental loophole, I just think that if you're going to be using it, you want to try and make your situation as clean cut as humanly possible. And I understand there's nuances and things around the short-term rental strategy that are not always clean cut. But in cases where, again, if you want to use a property for personal use, use it for personal use and just that's it. It's a vacation property, right? If you want to use the STR loophole, then in the first year, just don't use it personally, for more than 14 days. That's the biggest thing I could give you. And when it comes to actually trying to strategically use maintenance days or repair days. Like when you legitimately have to repair the property, you have to go there for maintenance purposes. And that's a great way to minimize some personal use days, right? But if you're trying to stretch it and trying to like fit all these complex, these iffy things around it, again, if you're trying to thread the needle, I would not recommend doing that. That's just my take on it.
And maybe just to add to that, Tom, if you don't mind, if you ever get audited, for those of you listening who are like, oh, I'll get away with it. If you ever get audited and your time log says 4 hours, 4 hours, 4 hours, 4 hours, everything's exactly 4 hours, just know, like, if I were looking at that, I'd be like, really?
Yeah.
What did you do? Right? It took you exactly 4 hours every day for all these things. And you might have some story and you might lie, and that's up to you if you have that kind of within your conscience and whatnot. But just know how crazy that's going to look if it's exactly 4 hours. So now don't try to get cute, because now if you try to say, oh, I'll make it 6 and then 5 and 4.5 and 5.5, whatever, then they're going to say, okay, that doesn't like raise red flags immediately. But what were you doing on those days? Does it really make sense that it took you X amount of hours to do those things? Okay. So like Tom said, please don't stretch it. Please don't lie. The other common question I get is, how is the IRS going to know how many hours that I put in? Well, okay, that's going to be really hard. I get that. That is probably the most common question I get whenever I explain the short-term rental strategy to people when I walk through personal use days. That's probably the most common question I get. At the end of the day, I don't know. But if they ask you for your log, they're going to look at that and figure out, does that make any sense, like I just said? Or if you're flat out lying, right? There was a court case I think we talked about, Tom, or you and Brandon did a while back. A taxpayer said, hey, I was at my property for these days. And then the court basically subpoenaed or something their bank statements, and they were in like London or something like that.
Yeah.
So it's like, okay, now you lied. Now you look really dumb. And now they're just going to say, oh, okay, yep, here's all your penalties, interest. This doesn't make sense. Here you go. So please know that there are certain ways that they could verify that. Also, social media is maybe going to be more of a tool that they could use to pull up, say, hey, where were you? Hey, you're posting all the time on Instagram, Facebook. Hey, I was here doing this thing, blah, blah, blah. Okay, is that personal or is that business? So just be careful. Yeah, I get people want to be, trying to stretch things, but we don't try to recommend anything like that.
Yeah. And then the last thing I'll say, just in general, before anybody, if you're listening out there, like, oh, we're just being some conservative CPAs. No, that's not the case. Here's the deal, right? Like, when you're using strategies that are legitimate yet somewhat aggressive, or can be scrutinized, or could be subject to scrutiny, you don't want to be taking unnecessary risk, right? The IRS, even though sometimes they get things wrong, people are not stupid, out there, and they can sniff out lies. Things have already been figured out, and it's just, again, when you're taking tax positions that give you substantial tax savings, you want to make sure you're doing everything as cleanly as possible to make your life easier, so that if you are ever audited, it's an easy audit, right? Not, oh, you decide to get too cute, as the term goes, and fudge some things, or played too close to the line, and then realize that you got too aggressive and lost an audit. So that's my bottom line there. Last thing I'll say here, we're going to be closing out the episode here, is we are having a year-end tax impact event that's taking place on November 15th. General admission is free. So when you sign up, you will be registered for general admission free of charge. You'll be able to access the event that day. Now, if you do want to go a little bit deeper, you can purchase the VIP tickets. The VIP tickets are going to include 2 VIP sessions. One of them is going to be a panel with, I believe, Ryan's going to be on the panel, and perhaps a few other members of our firm. And then we're also going to have a live Q&A with Brandon Hall and myself. That's your opportunity to get answers to your questions, kind of like this, but live at the event. Also, when you do get the VIP tickets, you will also have access to the recording, something that you will not get the general free admission. So just for everybody out there who's wondering, general admission is free. The VIP tickets will get you a little bit more exclusive access to events as well as the recording. If you do want to sign up, it's www.taxsmartinvestors.com/year-end tax impact. We'd love to see you there. I will drop that in the show notes. And as always, we are taking on clients. If you are interested in exploring your options, you're looking for a new CPA, new CPA firm, that's www.therealestatecpa.com/podcast. We'd love to learn more about your situation, how we can help. And we are hiring as we head into 2025. So if you are a CPA or EA and you're looking for a change, you want to work for a firm on the cutting edge, send us an email at onboarding@hallcpallc.com with your resume, your desired position, and why you want to work for a firm. We look forward to hearing from you. And that's it for today's episode. We'll catch you next week on the TaxSmart REI podcast.